Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's podcast is how to add $500,000 to your super balance, even in times like this. Michael, once again, you've done the calculations on this?
Well, I did the calculations. You came up with the title.
Thanks, man. I'm glad you gave me a bit of credit for that. I thought it was a pretty good one.
I wanted to call this something like how having a plan is very important during times like this. And he said it's not catchy enough.
Mate, you've got no sense of show business. No sense of show business at all.
Yeah.
It's funny because it does sound a bit showy, a bit salesy, but I guess this is what we say to people. If someone asks, the thing they talk about, if you're in an elevator and someone asks, what do you do? This is what we say we do. We add $500,000 to people's retirement savings over the last 10 years of their working life.
Yep.
So, I mean, you've done the calculations, but it's something. These are the sorts of numbers that we obviously both know like the back of our hand.
Yeah. Look, what we wanted to talk to the audience today about is not only how this can work, but also how it is really important to have a plan in place when markets are volatile. Episode 51 that we've just released. Why moving your super into cash right now could cost you $250,000. We talk about when you don't have a plan in place and you don't have a goal in mind or an objective, which is a dollar specific, time specific amount. So it's we want to retire at age 65 with X amount of dollars in our superannuation fund. The absence of that means that when markets drop away and you see your balance fund with Sun Super or Q Super drop from $500,000 to $375,000. The absence of having that strategy or plan in place means that you probably will panic and move that into cash at that point in time because you would think, this is lunacy. Why am I watching this continue to drop?
Well, and it's interesting because it may not even feel like panic, if that makes sense. It just may be that you don't know the impact of that decision. You don't understand why you have your superannuation invested the way you do. You don't understand what the true cost is of making that decision. So it's kind of easy to either panic and do it, or just to do it sort of out of I don't really want to do that. I'll just flick that across and it'll all work out. And it'll all come out in the end.
Yep, that's right.
So this is a bit of a case study that you've done up, which this is literally the template that we have when we do our calculations, that our sort of starting point, because this is what it tends to look like for the average person coming in to see us for the first time. So did you want to just run through what the inputs are there, Michael?
Yeah, absolutely. Look, it's different for everyone, of course, but what we tend to see is a high correlation of people coming to see us at age 55 for the first time. What they have as a couple is circa $500,000 in superannuation between both of them. Look, we know that their average income tends to be about $75,000 each, or $150,000 combined, and that might be one earning $90,000 and the other one earning $60,000, or both earning $75,000. We know that they're typically in a balanced fund. And of that $500,000 of cash, of that $500,000 of balance that they have together in their superannuation, about $150,000 of that is what we'd refer to as lazy money inside there. So it's not really pulling its weight too much for them. So it's in a cash or fixed interest environment. And at today's interest rates, certainly the return is really, really low on that, lower than what they require. And we know that they have about 10 years of working life ahead of them. So we
And-
basically
and
know all those things as the inputs.
we tend to have a lot of other things in common. They're not really relevant to the financial projections. They all seem to like to have a drink. They all seem to like to travel. They all like to have a good time. I don't know what it is, but that's the sort of people that
and
we
they
tend to attract.
and they like to stay. They like to stay physically fit as well. So they're it's not that they're
old soaks.
yeah, that's right.
No,
like to travel, like to stay physically fit.
Yeah.
They're interested in other things other than
Yeah.
work.
Yeah.
They all have outside interests. They like to
Yeah.
have a laugh, like to have a good time.
Yeah,
Look, it tends to
enjoy
be
spending time with their family, grandkids on the scene, that kind of thing. Yeah, so
yes,
it is interesting that we often see this, that people come in and like we've said before, it could be a very daunting thing to come in and put your cards on the table for the first time. And it's sort of, I think a lot of people are sort of worried that they're not where they should be, or that they're, that there's, that they're not on track, or that there's more they should have been doing, or that they don't know enough or something like that. So I think it's probably a relief for most people when we sort of say this is on average what we see. There's probably a lot of people listening going, "Oh, that sort of describes me," and it's a good starting position.
Yeah, absolutely. So I was going to add before, when they come to see us at age 55, most of those people are hoping it's not too late.
Yeah,
but probably deep down thinking that it may be. So during that first meeting that we have with them, they all leave relieved because we tell them it's not too late, and like a wise old coach of yours said, words to the effect, the best time to start was 10 years ago, but today
we'll have to do.
Today we'll have to do. So
there you go, Spence. Another little shout out for you there, mate.
So what we attempt. So first of all, we look at the base level of what they're going to end up with. So most people are actually pleasantly surprised that $500,000 on its own accord with their employer putting the 9.5% in, them not putting any money into it at this stage, and at an assumed 6% rate of return each and every year on average, that will grow to almost $1 million over the last 10 years of the working life. So compounding does take effect over that period of time.
Yeah.
So they're happy with that good news.
There's something magical about that figure as well. I think that, like we said, if for those people, if you said, right, by the time you're 65, you'll be very close to, if you've got a little bit of cash out in your own name, you'll be a millionaire. And for a lot of people, that's probably a big milestone, and they kind of, it feels like a huge amount of money that they probably never thought they'd have. So it is a bit of a relief to go, well, that's kind of the ballpark of where you're going to be shooting towards. Yeah,
look, it is a relief for people. We give them that benefit straight away, and then we say you're still going to be about $500,000 short from where you need to be. So
we've made them feel really good for about a minute, and then we go, it's probably not enough. You need a little bit more.
Yeah,
so,
look. Our target is to add $500,000 to their retirement savings in the last 10 years of their working life.
Yeah.
And there's a few inputs that go into that.
Yeah. Sorry. Before you do that, I just think it might be worth explaining why that figure. Like, I guess it's something that we like to have a bit of a round number to add, but I think it's easy for people to go, well, I'll be on track for about $1 million, and that's probably enough. And so what we were just talking about before, so the average person who comes in and sees us, when they get to retirement, they're normally fit and healthy, and they want to travel and spend time with their family and do some things, especially in those early years of retirement. What we tend to find is that $1 million, it just isn't quite enough to fund the lifestyle that most people want in those early years of retirement. And that's kind of why, obviously, we want to start with the goal in mind. The reason we need to add that $500,000 is not just so that we can puff our chest out. It's because that allows people to live the lifestyle they want.
Yeah, it's a good point. So in the control case, their $500,000 grows to $1 million without them doing anything at the rate of return of 6% on average per annum. Now, the issue with that is that they hit retirement with $1 million. Yeah. And the day that they stop going to work, means that their money has to get dressed and go to work for them.
Yeah.
So at a 6% rate of return on $1 million, that's $60,000 of their money making money.
Yeah.
Look, we know that they'll probably take about $80,000 in the first year of their retirement.
Yeah. Yeah. After being adjusted for inflation in the next 10
after
years.
being adjusted for inflation. So they're on the back foot straight away. So it doesn't seem like a lot. Your money makes $60,000. You take $80,000. You go backwards by $20,000. You start year two of your retirement with $980,000.
Yeah.
Now your money makes a little bit less money because on an average rate of return of 6% is 6% on $980,000. Yeah. Not 6% on $1 million. So it makes a little bit less. You take a little bit more. The cost of goods and services goes up. Yeah. Within a few years, what's happening is they're really eating into their original $1 million. And once that gets to $900,000, it's a really slippery slope from there because each and every year, 6% on a declining starting balance means that your making money is less, and we know that the cost of goods and services go up over time. So you have to take a bit more each year. So your $80,000 becomes $82,000, becomes $84,000, becomes $87,000. So all of a sudden you're taking $90,000, and your making money is only $50,000. And you're really starting to chew through that.
Well,
so
the example that I use all the time with this is most people have experienced the opposite of that compounding effect, which is when you're paying off your home loan. So you start paying off your home, or paying off any loan. If you owe $300,000, it seems like forever to take the first $50,000 off. So because you're paying interest on a full $300,000, most of your money is most of your repayments are going towards the interest, and nothing's coming off the principal, or next to nothing. And then it just seems like you're treading water for so long. And then as you start to get on top of that principal base, you then less of your money is going towards interest, more of it's going off the principal repayments. You start to very quickly chew through that. And so what we're really trying to avoid here is the opposite of that, which is that in those early years, if you don't have enough in retirement savings, and if it's not working hard enough for you, you start to chew into that capital base a little bit at a time. And once you've sort of taken $100,000 or a couple $100,000 off the top there, like you said, that really starts to ramp up, and you chew through that much quicker.
Absolutely, yeah. So it's a really good example that you explain there, because most people are familiar with that, with the repayment of a mortgage, and certainly people that are listening to this who are around 55 years of age would have paid off a mortgage, or all but paid off a mortgage, so they would have seen that in action.
Yeah.
So an extra $500,000 gives someone so many more choices. Number one is that they're able to take their $80,000 a year quite easily and actually reinvest some of the earnings. Yeah. And I'll get to that in a little minute when I walk through the example. So without running out of money, and there's a bit of fat there, because we know that from time to time our clients in retirement have stuff that crops up that they haven't budgeted for, and it means that they're $80,000 for that year because they needed the inside and the outside of the house painted is a little bit more than $80,000 that they need to take. So we for most couples that come to see us, having $1.5 million versus having $1 million it's just puts them in such more of a comfortable position with significantly more choices in retirement. Yeah, and it's something that they can achieve once you get the strategy started and on a roll. It's something that our clients comment that they do standing on their head. And step one of that strategy, I guess, of course, is first of all, we look at that 6% rate of return and we say, gee, if we could just bump that up to 8% per annum, that would make a big difference. And what we have the discussion with people is that of the $500,000 that they have in that balance fund that they're at, they have about, like we said before, $150,000 of that is a bit lazy money. It's sitting in cash and fixed interest, not really pulling its own weight.
Yeah.
It doesn't grow at a fast rate. It also doesn't drop during a market decline. But Dallas, you made a comment before in one of our previous podcasts that you still feel like you've been sold a pup if you ran the the Q Super Balance Fund or the Sun Super Balance Fund, because you were thinking that. I mean, I'll throw to you there. You can explain that a little bit more, but
basically, if you've got $150,000 in cash, but you've still got $350,000 that's invested, and so in the event of a market downturn like what we've just seen, your balance still drops dramatically, and so it doesn't make you. I don't think it makes people feel any better to go, oh, well, my balance has dropped by 25%, but if I'd been fully invested, it'd be down by 30% now. You're still just looking at it going, gee, that number is a lot lower than what it was 3 months ago.
Yes.
So I guess, and that's kind of what we're looking at here, is for someone who's 10 years out from retirement, you really, it doesn't, the advantage of having that money in cash, in as much as it not dropping in the event of a market decline, it doesn't help you if you're not going to be accessing that money for 10 years' time anyway. So there's really no advantage to not having that money working for you.
Yes, and our modelling suggests that if we were to move that lazy money all into higher growth assets, that on average would add about 2% of a higher rate of return to someone's.
I really like I like the way that you instead of, most people would think of that bit of it as their safe money. Oh yeah, that 150,000 is safe. So calling that lazy is probably a better way to break that down into how you should be thinking of it. It's not about safety; it's about laziness. It's not working.
It's about laziness, I think. And I mean, your example hits the nail on the head. You have safe money in there. If you think of it as safe money, you're still not seeing that as safe, because your $500,000 is still dropped to $375,000. Yeah. At the bottom of this latest market cycle, when the markets in Australia dropped away by 36%. What that meant is that $350,000 of your $500,000 fell 36%. $150,000 of your $500,000 didn't fall at all. But it also won't grow in good times. So you still saw a 25% overall fall to your $500,000. Now you're not thinking at all.
I'm glad I've got.
Geez, I'm glad I've got that $150,000 of safe money in there. Because you're still living and feeling that volatility, and I guess one of the points of this particular podcast we're looking at now, and a recurring theme over the last couple of weeks, while there has been market volatility, is that if you have a strategy and a plan in place, and you understand why things fall and that they come back and then they grow to new highs, and why you're doing what this is all about, if you understand all of that, then you're far more likely to hold your fortitude during these periods of time when there is market volatility. But increasing the rate of return, so without putting one extra cent into your superannuation, increasing the rate of return from 6% to 8% per annum on average, that actually gets you an extra $157,000 of retirement savings by the time that you retire. So it's quite
a big jump, considering, like you said, that's giving nothing up out of your own pocket. It's just working that lazy money a bit harder, and gets you from $1 million to $1.15 million.
That's right. And I just point out here, look, I'm talking about our average clients here. So if you're listening to this and think, I'll move all my money into, I'll get out of this lazy money balance fund and move it all into higher growth. We're not giving anyone personalised advice in this podcast.
This is the legal mind coming out of you now, going,
We're just explaining how we break this down for our average clients. So basically, how we break this down and say, okay, what we need to get is we need to get you.
I think we do have a disclaimer that goes at the front of the podcast, doesn't it? Isn't there some lady who says with a really nice voice about this is not personal financial advice? Yeah, she does. So
we do. But we have another one now. We have another one.
we've got a scary bloke saying, "Don't try this at home." So
so that will add $157,000 to those clients' retirement savings just by moving that lazy money into pulling its own weight, and in the of course, if the assumption is true, and we believe it is most of the time, and it is true most of the time, that 6% will bump up to 8% rate of return on average with us doing that. And we won't go into the specifics of the investment strategy because that could be seen as personal advice. But then just to say we're just working that money harder.
It's I guess like the language that I often use is it's just finding a lever to pull. We just go that's one of the levers that we can pull to make a change there, and the specifics of how we do that and whether that's appropriate for everyone or some people and which others. That's, I guess, like you say, it's a matter of actual personal advice and specialized advice for each individual. But it's a great example of the sorts of things that you can look at there. So that extra rate of return gets you a bit of the way there. How do you get the rest of the way there, Mike?
So the next lever that we want to pull is we want to go through someone's budget. Well, you don't want to do this. You just want to take the money, Dallas. But
I just want to take the money. I just work backwards and say, look, we've agreed that this is the lifestyle that you probably want to live in retirement. You want to travel. You want to do these fun things. You don't want to run out of money in retirement. You need $1.6 million thereabouts. I need you to put some money into your super fund each year, and this is the amount of money, and I don't really care what you have to cut to make that happen. So I work backwards from that. You actually don't mind going through Bill's budget with them, but
I don't mind it because I can add up as we're striking a line through different things.
Yeah,
I can add that up in my head, and look, it also, at risk of digressing here, it also allows me to see what they've said their budget is and what their budget actually is.
Well,
and look, I love it. I love it when they say when they finally admit that they're giving $1,000 a month to their working adult children. I say, right, this is fantastic. So we've just found $1,000 a month that from this point on can go into your superannuation fund.
Yeah, that's right.
So it begins because what we're going to ask people for is $35,000 a year for the last 10 years they're working off to put into their superannuation fund. In this case, because $150,000 at 9.5% employer contribution means that they have only just a little bit short of $15,000 going in from their employers' contributions. So we need them to add in $35,000 to their superannuation. And like you said, Dulce, you just work that backwards and basically divide. If they get paid fortnightly, you divide $35,000 by 26 fortnights and ask them to put in a combined amount of $1,345 between them, which shocks the hell out of people, of course, when we're firstly sitting with them. What we can tell you is that after they put that plan in place, a couple of things. Number one, they report back to us that they've done that standing on their head after we meet with them after 4 pay cycles. And they say, geez, that was easy because all of our other expenses just fell into line. What we also tell them is, look, that's going to be tax deductible. And it's
a bit of good cop, bad cop, isn't it? We take away with one hand and then you go, well, here's the good news.
Well, the good news is that you do that for 12 months and at your tax rate, and in this case, their tax rates are 34.5%. Done correctly and claimed as a tax deduction, what they'll get back is $12,000 between them as an extra tax return. So what it's really done is we use it as a bit of a forced saving because most people are saving $12,000 a year for things like travel or holiday, various different things. Things around the house. So we say to people, hey, why not just put the money in? We'll claim that as a tax deduction at the end of the year. And that $12,000 will come back to you, and you can use it for big ticket items like a holiday or a new car. You might put a couple of years together to get a new car, of course. Various things like that. So look, the true cost.
We've discussed this at a fair bit of length in other podcasts about the difference between whether there are a million ways to skin this cat as to whether how do you fund that? How do we find that money? There's all sorts of different options and things that we can look at. It's not just a matter of going, you need to come up with 35,000. As you say, there's different ways that we can look to fund that. But at the heart of it, that's what we're trying to do, is work out the amount of money that needs to go into there, and then get that in the most tax effective way, so that what it's really costing you is far less than the actual dollar amount that's going in.
Yep. And so yeah, if you can think of this two ways. You can think of it as costing you $35,000 a year in this example, and you're getting back $12,000 of savings. Or you can think of you can net that out, and you can say it cost me $23,000 out of my own pocket. So, and here's the power of this: so $35,000 goes into your super fund, and the real cost to you is $23,000 out of your own pocket. Now, I mean, the $35,000 does get taxed at 15% going in to your super. However, that's still $29,750 of after-tax dollars that adds to your super fund. And the cost to you has only been $23,000 per year. So that's free money. And that free money of $6,750 a year, once it's gone, it's gone. And if you don't take advantage of it, then you lose it forever, effectively. So we would say the cost to you here is $23,000 a year. And using those two inputs, so moving the lazy money in, and if you get the extra return of 8% instead of 6% by working the lazy money a little bit harder, then if you give up if this couple gives up $23,000 a year of of after tax savings, then their superannuation, which was on track to grow from $500,000 to $1 million, actually grows from $500,000 to $1.6 million. So it's actually $600,000 ahead of where they were going to retire to. We say $500,000 just to leave a little bit of room to move.
Safety there,
margin of safety, but it will actually get them to $1.6 million.
Yeah, that's right, and that's I guess the thing where it's those two things working as we've just seen. It's a matter of pulling all those levers in together, making sure that money's working as hard as possible, making sure that you are picking up all those tax savings, making sure that you're actually giving up enough out of your net income every fortnight or every month. All those things working in together is what makes that happen. So if we just talk about the numbers straight off the bat and go, your super's on track to get $1 million and it should get to 1.6 instead, it sort of seems a bit magical. It seems $600,000 or $500,000. It just seems a bit too easy. But if you break it down and go, it's just the combination of all these different changes over 10 years, what that compounds out to.
Exactly. And point 3 of where we want people to end up is we want them to end up with almost all of their retirement savings inside their superannuation. Yeah, because we know with legislation, once they've retired, they're over the age of 60, which they are in this case. We can move that money into a tax-free sub-balance, let's call it, of superannuation, called an account-based pension, which is effectively like having a tax-free company or a tax-free trust. So your 1.6 million earns a rate of return. Now, going back to that 8% rate of return, here's the importance of bumping up for these people their return from 6% to 8% as well. They now have $1.6 million that's earned them along the way an 8% rate of return. An 8% rate of return on $1.6 million is $128,000 a year. So before, when I said the day that you retire is the day that your money gets dressed and goes to work for you, the money is pulling its own weight because it's made $128,000 of. Now, you can look at that in two ways. We said that the average client of ours needs to take about $80,000. And by the way, the $80,000 they can take is completely tax-free because the way it's been set up in this case, there's no tax to pay on that income. So if you take $80,000 and your money made $128,000, what you're reinvesting back into your fund is $48,000. You can think of this in two ways. You can think that you could take up to $128,000 of income in that first year of your retirement and not go backwards, not grow, but not go backwards. What we prefer to do with our clients is to take less than what their return has been. So that they can reinvest the money back into their fund and grow the fund, so they can take more of an income the following year. So, look, it's vastly different, isn't it, from the first scenario?
Well, I was just about to say that the thing about that is, once you get to that point in time, you can make that decision of, if you've got 1.6 million, you can either take $80,000 a year indexed to inflation and never ever worry about running out of money, and you know that your balance is going to continue to grow and you can just live on that, or you can make the choice to take a higher amount in those early years and take more and take less later. You can choose to chew it down a little bit in these first 5 years. There's a heap of different things you can do, but you're in the box seat there, where you've actually got choices that you can make, as compared to having $1 million. There's just there's no room to move there. There's no choices. There's no extra that can come out at all.
Yeah, that's exactly right. There's plenty of things that you can do. Different ways to put. You can put, the extra $600,000 in a separate account. This
is your favourite one to do, since you're such a siloer of money. You like to have separate accounts for separate things.
Yeah, well, you can run that money down by taking extra and going on as many holidays as you can. Over it, some people would purposely take the extra $600,000 that they've come away with and say, well, we're going to run that money, that 600, with our original $1 million, we're going to take $70,000 a year or $80,000 a year from that. And have that tread water with the $600,000. We're going to run that down purposely. We're going to take extra money from that because we want to travel and we want to do this and we want to do that. So, look, you've got plenty of choices in what you can do at that point in time. I guess that gives us the ballpark of where our average client needs to be in the last 10 years of their working life at around that $1.5, $1.6 million mark at that point in time. So I guess when I look at the cost to people, there's a couple of costs here. Of course, the cost, there's a dollar cost of $23,000 per annum after tax. So they're putting in $35,000 in this example to their super. They're getting back $12,000 as an extra tax return. The net of that is about $23,000 a year. So that's a cost to them. We don't think it's a great cost because, like, we find that as people have been promoted, just rubbish creeps into their budget, and they're spending money on this and that and
things they don't really enjoy.
Not really getting much enjoyment out of it. Certainly nowhere near the enjoyment of you telling them, hey, if you come away with an extra $600,000 in the last 10 years of your working life, it gives you the ability to go on 3 overseas holidays, every 2 years, for example, and do that into perpetuity. So that's a cost. Look, I've mentioned here the other cost is your fortitude that you are doing the right thing when markets drop. So, for our clients that have made this move from the balance fund, for example, into the higher growth fund, at the bottom so far, when the markets had dropped by 37% 2 weeks ago, they were down 37% on their on their $500,000. The people that left their money in the balance fund were down only 25% because 70% of their balance was falling, 30% wasn't falling. So there's fortitude here. However, Dallas, we've discussed this. Look, we find that our clients are more, because they've got a plan in place and because they are working towards the $1.6 million, and because they understand why that what we call lazy money has been moved into high growth money. Because they understand all those inputs and levers. I like the word, it's just another lever to pull. Because they understand the levers that need to be pulled.
It's much easier to stick to that.
It's much easier to stick to the plan at that point in time. So,
and I think, and we literally talked about this on a podcast the other day about thinking of that as a fee versus a fine. People understand, and we just talked about this in the last one as well, is that most people understand that there's no free lunch. You don't get something for nothing. So that is the cost. The cost that you have to pay to get that extra return is that you are going to see more short-term volatility, and that's the price. Or the cost that you have to pay is to have that fortitude to just stick to the plan to see that through when the markets are dropping. And that's I guess the way to think of it is that for our clients, they know why they're paying that cost. They know why they have to go through that volatility. It's not just some black box of something that's happening behind the scenes and they don't understand it. They know exactly why they have to go through that. And so I think you're right. It's easier to have that fortitude and to stick that out.
Look, I think I love that analogy that you use. It's a fee, not a fine. So I mean, I can't state this for fact, but I would be believing that our clients think of this market volatility as the fee.
Yeah.
Whereas people that don't have a strategy in place, don't have a plan in place, they see this as a fine.
Yeah, they've done something wrong, or they shouldn't have done this.
This is China's fault, or it's Trump's fault, or it's America's fault, or it's China's fault. It's like it's one of those things that they don't understand why it's happened,
and it feels out of your control, and it feels it is a very different experience to something where you get, this is a choice that I've made. This is something that I know I have to get through to get to an end result that I want.
So I guess that's all I had to say today on that.
Yeah, I think that's a pretty good place to wrap up. There is that, like you said at the very start, what we're really talking about here is the benefit of having a plan. None of what we've spoken about here is very convoluted. It's not very, I mean, it may be, like we said, it's something that we do day in, day out. So it's just a very standard thing for us. None of this is rocket science. You know, it's not that complicated. It's really just about going, where do we need to end up? What sort of plan do we need to have in place so that we can make that happen? And then it's really just a matter of paying the financial cost of being able to put aside that money every year, do the right things in order to save that tax and to build up that super balance, to pay that financial cost, and then also that emotional cost, the ability to have the discipline and have the fortitude to just go, this is the plan, this is where I'm heading to, and I'm going to stick to that plan for the next 10 years.
Yeah, look, that's spot on. And I think, great place to wrap up for today.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.